Well, emerging markets have been very weak of late, and I suppose there are three big issues here. The first issue is a demand issue. So we've seen the impact of the coronavirus on economic activity across emerging markets, and that has meant that many companies are seeing a big hit to their revenues, and as a consequence of that, declining cash flow and ultimately profitability and earnings. So the market has been busy trying to price that in, and as a result, prices are a lot lower. So that's the first issue. The second issue is one of supply. So we've had the oil shock, whereby supply has increased quite dramatically from OPEC and Russia in response to trying to tackle the shale industry. You put that together with weaker demand overall for oil as a result of the coronavirus, and you've had this precipitous decline in oil price. Now that has a negative impact in the short term, as it means that large chunks of corporate EM get impacted as a result of the declining cash flow. But it also has an impact on many emerging market countries or oil exporters. So you've seen both the companies and indeed the countries suffer as a consequence, and that's a shock to the system. But you bring that all together with the third point, which is that there's been a liquidity crisis. And the liquidity crisis is simply this. Financial conditions have first tightened significantly across emerging markets as the crisis has taken hold. There is generally a shortage of dollars, and as a result, what you're seeing is the decline in emerging market currencies relative to the dollar, and things have got a lot tighter with regard to finance, and therefore financial assets falling. But in addition to that, as we worry about the economic impact on companies, you're seeing a cash flow crisis or liquidity crisis or cash flow. And that's where companies are unable to generate the cash flow to be able to pay their suppliers, their workers, and various other folk. And as a consequence of that, that similarly has big, major implications for the ability of these companies to survive, and indeed economic activity more generally across these markets. So that's all the big stuff that is going on, not just in emerging markets, but certainly something that emerging markets are having to deal with. So how are they dealing with it? And I think here we have some positive examples. So quite clearly we've seen in China the move to very quickly tackle the coronavirus and bring that under control in terms of infection rates. And the good thing there is that as that has come through, we're beginning to see some normalcy return to the Chinese economy, which is good both for emerging markets and indeed China. And the second thing is that the governments are moving to try and provide a bridge for many of those companies in cash flow difficult circumstances, but also looking at ways to try and stimulate the economy in this downturn. So there is definitely policy action that's occurring, which is helping at the margins. But until we see such time as a peaking of virus infections and clarity around the amount of government intervention and activity globally, it's hard to see where there is a flaw to the underlying emerging markets. That said, emerging markets are doing better overall than developed markets, of where they're much further behind in terms of tackling both these crises. So I would say that the outlook for emerging markets looks relatively better than many developed markets. Valuations certainly reflect an awful lot of risk, but the key thing that people need to be comfortable with is that we're closer to the end of the infection crisis and therefore impact on economic activity than we are to the beginning, and in which case potentially there's opportunities here. In terms of what we're doing in the portfolio, the key thing that we've been doing in the portfolio is we've been shifting money into China as a reflection of the fact that China was first in and therefore first out, and we're beginning to see that recovery in economic activity. Over and above that, we continue to look for ability or the opportunity to be able to trade out of companies where we have lower conviction to companies we've liked but have been wary about the valuations, because there are some big valuation moves today, and as a result opportunities are being thrown up. So again, we've been adding to China. The area where we are increasingly more interested is, given the sharp fall in many of the share prices, is Brazil, where we see a number of high-quality companies are being sold off quite significantly, and there we would like to potentially add additional money going forward. So very much keeping our heads in these difficult times and looking to make sure that we allocate money to where we think we'll get the best returns going forward.